Thanks for joining in again tonight. I'm very excited about tonight. It's about option contracts. A lot of people don't even know what they are. So just so we get it clear before we get started, for those guys that are watching tonight I'm going to be talking about option contracts. So that's not auction, option, O-P-T-I-O-N. That's what we're talking about tonight. A lot of people aren't even aware of option contracts, what they can do, how you can save basically stamp duty. You don't need a bank loan necessarily. So I'm going to go through the beginning. So this is just part one. I'm going to break down a little bit just about the actual contract itself, how it works, how it's different to a normal land contract, and how you can put this sort of stuff together. So tonight, guys, bear with me. I'm on a new computer again. If I do make a mistake, I'll come back to you. But guys, yeah, I'm very excited. So let's get stuck into this, guys. I'm going to share my screen. Give me 2 seconds. I'll get this party started. All right. So, guys, just remember, if you have any questions, feel free to pop questions into the comments, put them in the group, whatever. That's what I'm here for, is to answer your questions. We don't charge for questions. We just want to make sure everybody has a good understanding of property investment. So the more the merrier, in my eyes. So, all right, let's get started. So property option contract. So for those of you that don't know what that is, hang on a sec. Sorry, option contracts. Oh, sorry, I forgot. Disclaimer, the boring disclaimer. So everything we're talking about tonight is general in nature. Please don't be a dickhead and go and do something stupid just from this 20-minute conversation we're going to have. All right, so option agreements. So just so we got that clear, everyone sees at the top there, it's not auction, it's option. An option agreement or option contract is a bit different to a traditional contract of sale that you would normally see in your state or territory, but an option gives you control over the property. So you'll see, as we're going through the professional investment subjects and a bit of learning about what's out there in the marketplace, you will definitely see that control of the property is more beneficial in some cases than physically owning it. So this is one of those examples. So this outlines, and I'll read it out to you guys in case you guys are on the phone. It could be looking a bit small. An option is essentially an agreement made between a vendor and a purchaser to exchange land for an agreed price at an agreed time. This can allow a vendor to achieve a higher than market value for their asset. Generally, the option terms range from 3 to 36 months. I have heard of 48 months, but traditionally 3 to 36 months, depending on what you're doing, whether you're just doing a small site or a big site. Like those big guys like Westfield, they would do 3-year, sometimes 4-year options on sites. The vendor doesn't have to move home straight away. So basically they can stay there while that option's going through, so they don't have to rush out to find the next property. So when putting together an option, normally because you're asking for 2 years or more, you would normally pay more for that property on the basis that you can see the value in what that property can potentially do. So what you're doing in a nutshell, you're manufacturing capital growth out of this property by giving its true value of what it has the potential for. Or basically best use of the land. You may have heard me said that on many occasions, but best use of the land. That's what an option can do. It's a little bit different to a standard contract of sale, but it's I love options. So I'm just going to clarify. This here is a traditional property contract, and this is relatively similar in every state. So every state's different. So obviously contracts related to properties are different for each state. And different rules and regulations. That's why real estates have to have a license in each state they want to work in. But basically, this is simple. A traditional property contract will normally have a 10% deposit. Now, even though it's traditionally 10%, that can be negotiated down to as low as $1 if that's what you want. That can happen. But traditionally, it's 10%. And this is what your local real estate agent would use, is just a normal property contract. And probably 80% of the time, I reckon you have to pay a 10% deposit. If it's less than that, you may be able to, a more common is a 5% deposit in relation to that. And then, of course, whatever else after that. But that's definitely negotiated in the beginning. Okay, so if you have a standard property contract, you're actually contracted to take ownership. So if you pay your 10% deposit, lock into the contract, the traditional is 4 or 6 weeks, you have to take ownership on that property, or the seller or the vendor will take your 10% deposit. You can't change, and another thing, in most cases, that 10% deposit is actually held in a trust account on your behalf. It's more rare nowadays for that deposit to be released at all. You can't change the name of the purchasing entity once the contracts are exchanged. So if I buy it in my name, I can't change my mind over that 6-week period before exchange of contracts and taking ownership. I can't change my mind and say, okay, I actually want to put this in a different name. For me to do that, it's a bit of a complicated process, and you don't want to go through that. And sometimes you could pay double stamp duty, so definitely don't do that. When you buy a standard contract, you definitely, unless you're a first home buyer out there, you're obligated, I think I spelled that wrong. Oh, that's right. Obligated to pay stamp duty or transfer duty, as some people might say it. So if you buy the property, pay your 10% deposit, you're going to pay stamp duty on that property on or before you take ownership. Traditionally used by real estate agents, like I mentioned before. You would normally have a bank loan or settlement monies organised. Now, if you've got a really long-term extended period before you're going to take ownership, like an off-the-plan apartment or unregistered land, you may not get a bank loan. Only 50% of my clients get a bank loan. Normally only the new clients, the ones I've had for extensive time, normally don't worry about a bank loan at that point. But you would, for traditionally a 6-week contract, you need a bank loan or you need cash. You need to be able to pay for the property. Now, even though you do have a traditional land contract, you can on-sell the property to another purchaser prior to you taking ownership, and you don't have to take ownership. You can do what they call a simultaneous settlement. Basically, you can settle. I have heard of off-the-plan apartments, those ones that take 2, 3, 4 years and the market moving up in value, where the first person's on-sold it to someone else, and then that person's on-sold it to another person. So you basically have 3 people in line between the builder and the last person, and the last person pays their money, and it goes right down the chain reaction to the developer getting paid. That's a high-risk investment structure, but I have heard of that, especially in 3 or 4 years. You may change your mind that you might not want to live there anymore. You might have 1, 2, sometimes 3 kids, who knows? And you can't fit in the apartment anymore either if you were going to plan on living in it. So you can on-sell the property and not take ownership, but you will pay stamp duty. You will definitely pay stamp duty no matter what, because you signed a traditional land contract. Alrighty. So the first one I want to talk about here is what we call a put and call option contract. So a put and call option contract is very similar to a land contract, where someone has to take ownership at the end of the contract, but these are used very often in a no money down deal. So for those of you on Facebook, I'm guessing you all are because you're all watching this now, a no money down deal, to do that, in many cases, it's an option contract involved. And I will explain that next week on how you can do that. An option fee or deposit is very negotiable. It can be down as low as 0. And the reason why you would be able to negotiate 0 is you're going to spend a lot of money on putting through development approvals or doing research on the land. So if you don't want the property anymore and the owner's happy to take it back, you spend a lot of money on that, getting it ready. But the option fee can be negotiated, especially if you do offer more money for the purchase price. So say, for example, the value is 500, you might say, listen, I'll pay you 550 for the 12-month option, put and call option, but I want to pay you 0 deposit. So depending on how good your negotiation skills are, what value you're presenting to the person that's selling the property, will depend on what you can structure with the negotiations. Ownership must be taken at expiry of the option contract. So that's settlement at the end of the day, but ownership has to be taken under a put and call option contract. But the benefit with the put and call option contract, 2 or 3 main benefits here, is if you're purchasing in your own name, you can change the purchasing entity, say from your name to a company, prior to expiry or settlement of that property. And why would you do that? Many people would ask me, why would you do that, Wayne? Why would you even bother? You might lock it into your own name. That might give comfort to the person who's selling the property, that you're a real person, not a company that can just disappear. But from accountant's advice, and depending on what development approval or whatever you're doing with the property, you might say, oh crap, if I leave that in my own name, I'm going to pay too much capital gains tax, or I won't get funding through a private bank. So what they'll do is they'll change it to a company or a trust or something along those lines. Now, when you do that under a put and call option, you don't pay stamp duty. You don't pay any stamp duty whatsoever. And the best thing is you can actually on-sell this contract. So if you pay $550, you put your development approval through, now the property worth is $800, you can actually on-sell that, say, for $750, so it's a win for everybody, to the next person and not pay stamp duty. You just take the profit and move on. You've done all the hard work. You've outlaid all the money for the DA. So there's probably like 200 grand profit in that. But if you can do this on a regular basis, say once a year or whatever it might be, you don't have to pay stamp duty on that transaction. It's a buy and sell strategy that we use on a regular basis. If that is what someone wants to do for a quick turnaround chunk deal. If that option is not on sold to another entity, so another person prior to expiry, you don't, I've written it wrong here. If the option is on sold to another entity or to another person, you don't need a bank loan, because you're not going to take ownership, okay? You're not going to pay stamp duty. You're not going to take ownership. All you have to do is pay for all the development approvals or whatever it might be, and then you collect the profit at the end of the day. Of course, that's classed as income, so you're going to pay a crap load of tax, but I'm okay with paying tax if you're making profit, guys. And all it is, you've got to work smarter, not harder, in these structures, so that, sure, you cop the tax bill, but you're not going to work hard for the money. All right, so that's what we call a put and call option contract. So put and call basically is, for those who do share trading, they'll know exactly what I'm talking about there. People don't even realize that contracts exist in the property industry. So a call option, there's not a lot of difference between a call option and a put and call option. A call option is my favorite contract every time if you can get it, because the benefit with this one, the only real difference that I see, and don't get me wrong, I'm not a legal person, the only difference that I see is that the ownership, you do not have to take ownership. So say, for example, you do a 1 year, 2 year option, and the shit hits the fan. You find a green tree frog that's endangered, you find a plant that's endangered, and you can't do the deal or do the structure that you want to do. You don't have to take ownership on that property, because it's just a call option. So they can't make you take ownership. You can just give it back to the original purchaser, and that's it. All right. So a call option is the best contract to use. If you're confident with the site, of course, you've got that put and call option structure there as well, if you need to. But depending on who you're talking to and how good of a negotiator you are, just be honest. It's all I can say. With these option contracts, I do see them being used in some scenarios where people don't even realize what they're signing. So just be honest. They've got to understand you've got control of the property for 12 months. If the deal doesn't come together, of course, you can walk away. But of course, what's the best way of getting this call option contract signed? Normally, it's to offer more money. So purchase the property for more money. That will normally get the deal across the line. So if it's a high risk property, put a call option out there for more money, but normally your high risk property will give you higher returns. Okay, guys, so a call option is okay, because if it all works, as long as that purchaser doesn't go and buy another property, which of course you would advise them not to, if the call option works, it'll pay off for yourself. And everyone's a win-win. The seller's a win, you're a win, and depending on what you're doing with it, obviously you want to make the next person win as well. All right, so this is how I want to explain changing of a purchase entity. So a lot of these people don't know what this means. So on the front page of the option, or within the option, sorry, would be the best option there. Within the option agreement, it'll have who is classed as the purchaser. And in this scenario, it's me. So I'm over here, Wayne Jessup, purchasing this house. And I'm not sure I'm going to have an option period down the bottom here, say 12 months. So I do my investigations, and I chat to my accountant in relation to the tax side of it as well. And he or she will go, okay, Wayne, it's okay, take ownership in your name. So in that scenario, bang, in my name, simple. You might say, they might say, Wayne, put it in your company, put it in your family trust, depending on the tax strategy that's behind it and what development or DA approval you plan on doing, will come down to whether you do it in your own name, company, trust. You might even put it in your super fund, who knows? So that's changing of a purchase entity. And of course, this fourth option is if you were to on-sell that option and you transfer the option rights to the next purchaser, obviously you charge an option fee for that. That's your profit. But that also is a way of doing it. So you've got options here. You just go purchaser, put it under a call option or even a put and call option. You can change who's going to physically take ownership on this property. Obviously, there's probably another 10 different structures there. But that's the way I always suggest to do it. And it's a good structure to do. I've done it myself several times, but just doing through this option period, you've got to make a decision. Obviously, it's normally about 30 days out. You've got to make a decision who's physically buying the property, guys, all right? So what I want to do, here we go. I think you can see me now. So that's how the best way for me to explain an option contract. So next week, I'm going to go into the more of a practical side. I'm not sure whether I'll finish next week or it might roll over to the following week as well. But tonight, what I wanted to show you guys as well is just one I've physically done myself. So this one here, I actually bought a factory bay unit for myself. Bear with me here. Oops. I just want to share my screen again. Because people think this agreement is going to be huge, but it's not that bad. So I hope you guys can see that okay. Bear with me. I have no idea how to work these things sometimes. All right, so this is what they call a put and call option deed. So this was a put and call option deed. I bought a factory next to my office. But when I purchased this, there was two things. When I was negotiating this with the owner, he didn't want to exchange contracts prior to the 1st of July because of capital gains tax things. And I wasn't exactly sure how I wanted to take ownership, whose name I wanted to take ownership in. So I actually started this in my name and I ended up settling in the ownership of half my name and half a super fund, which was actually a partnership, which was another complicated structure again. But I bought the property in my name under a put and call option deed, and then I settled with it, say, for example, just super fund. So I have blacked out the parties, some of the parties, sorry, with this. But with this, this is, I think it's 12 pages in total. It's really only 10 pages. The other 2 pages are irrelevant. But it just breaks down who the vendor is, how the option works, how it's entered into. This part here is very important, nomination and assignment. So that's what I talk about. When I talk about selling it to someone else, you're basically nominating or assigning it to someone else. That's a very important part to have in there, because what you want to make sure is this is easy to do. Otherwise, the option contract's useless. If you don't exercise the option, you'll lose your option fee. So it sort of breaks it all down, right? So this, when you enter, like we supply these, obviously you want to get it checked by a solicitor, but we supply these to our professional investors to use, because some of our professional investors just go and do this all themselves. I did one just a couple of weeks ago for a client who was buying a site. And then, of course, down the bottom here, I've highlighted a few things, very important things, guys. So definitions, you want to make sure you have all this done. Call option expiry date. So when does my option expire? 20th of October 2017, and I had to take ownership, I think, by the 20th of November. Call option fee. So in this scenario, because I knew I wanted this property, I just paid a 10%. You don't have to do that. That's not irrelevant if it's $5,000, whatever. 32.5 grand I outlaid, and the period here, 3rd of July 27 and ends on, actually, I was putting dates wrong. 29th of September, I had to make a decision who was taking ownership of the property. And then, of course, you've got the purchase price, 325 grand. Very, very important. You have the purchase price, your option fee. So, and for those guys that aren't aware, that option fee of 32.5 comes off that purchase price too. So I did pay a little bit more to have this structure because I really wanted the unit next door to me. It was more for my own personal use at that point. But I paid a little bit more because it was convenient, because it was right next door to my office. So for those of you who know me, I'm a little bit of a workaholic. I wanted the property next door, which made it easy for me to if I wanted a bit of a break from work for an hour or 2 hours or whatever it might be, I can duck next door and do what I need to do to catch up with some personal stuff, as in car stuff or whatever it might be. And then, of course, it's got to be executed correctly. And then, of course, at the back of it, you actually have the contract. So the contract, I've only just done the front page here for everybody, but the contract itself, you have to, at some point, sign a traditional land contract. So this one's New South Wales. So I had to sign this contract at the expiry of the option. And when I transferred it or nominated the right entity I wanted to buy this in. So as you see here, it starts off in Wayne Stephen Jessup, but it would have been put into the super fund at the other end. Now, one thing I want to show you guys here, which is the most, I believe, the most important part when you're trying to negotiate options, a lot of real estate agents have no idea what you're talking about. That they might be good at their job, as in selling homes under the traditional sense, but I went direct to the owner on this. So going direct to owners to get the option contracts organized will always get you a better outcome. Why? You're talking directly to the owner, which we give you scripts and dialogue on what to use. And just remember, this is all legal. I'm a very ethical person, so you've got to make sure everything's going to work. But you see here, what I've highlighted here is without the intervention of an agent. So what that means is there was no real estate involved. All it was me and the existing owner. We negotiated the outcome and moved forward with that. Oh, excuse me. I don't do this to escape real estate agents' fees for the owner. I do this because when I explain the offer or the deal I want to present, it's a lot harder when you use a third party in between because it doesn't get translated as well as what it could. You can put it in writing, but as everyone knows, you can send a text message and the other person can get offended when you weren't even trying to offend them. So it's very important when you're getting into professional investing, sometimes you really don't want to have the agent involved. And that in that scenario, I teach you on how to find deals without agents. And that's just a lot of legwork, guys, but it's well worth it if that's something you want to do. All right. It depends. Do you want to work for the rest of your life or do you want to become a professional property investor? If professional property investing is not for you, that's great. But I still want to open your mind to what's out there in the world, especially in Australia. All righty, guys. Now, do we have any questions? Actually, I've been talking a lot tonight. That's all right. Not too many questions tonight. Okay. But guys, like normal, if you have questions, pop them into comments. Jess will probably pop in a link there in a minute for a 15-minute call. I normally get about 2 or 3 calls a week from that. And it just, what it is just to see what your scenario is. Can you buy a property? Can you not buy a property? What's the risk involved? What your big fear is? And you got 15 minutes where I can have a chat with you. If I can help you, I'd at least give you some direction on what you can do. Yep, there you go. Jess has popped that in there now. But guys, thanks again for watching tonight, whether you're watching it now, whether you're watching it tomorrow, the next day, whenever, on the YouTube channel, whatever it might be. Guys, thanks again for watching tonight. Next week, I'm doing another part, a bit more of a practical sense when it comes to property options and how they can work for you. And the reason why I wanted to bring this up now is because I'm going to be talking about option contracts in a lot of the strategies I talk about, and also a lot of the next level investing. Property option contracts is what we use to get it all secured and get control of the site. Alrighty, guys, thanks again. I'm Wayne Jessup, the Property Bloke. I'm bringing you real property, real strategies to obtain real results for the everyday Australian. Thanks again, and look forward to chatting to you again next week.